When you're thinking about buying a home, there are two primary factors to consider. How much do homes cost and how much can you afford? In this video, I'm going to be going over the second factor regarding how much you can afford based on your mortgage and your down payment. And make sure you stick around right till the end because I'm going to be going over some key mistakes that you're going to want to avoid when getting a mortgage, which includes the one biggest mistake that I see people do over and over again. So don't go anywhere. What's going on, guys? My name is Alex Dunbar and I'm a local realtor based out of the Surrey and Langley areas here in BC. If this is your first time on my channel, I make weekly videos pertaining to the BC and Canadian real estate market, as well as showcase community tours across the Lower Mainland. So if that's something you're interested in seeing more of, I suggest you consider subscribing to our channel. Before we get started, I just want to clarify that I am not a mortgage broker and you should definitely speak with a mortgage professional before making any decisions regarding your financing and purchasing a home. If you don't have a preferred individual that you'd like to work with already, I've got a couple that I work closely with and I'd be more than happy to recommend to you. Just reach out and I can send you their contact information. And with that, let's get right into it. Understanding your mortgage affordability is crucial when you're looking to buy a home. It's a complex process that involves several factors, including your income, debts, and the value of the property that you're interested in. This comprehensive guide will walk you through the essential steps and calculations needed to figure out how much mortgage you can afford, ensuring that you make an informed decision when purchasing your dream home. First, let's discuss the loan to value or LTV ratio, which is a fundamental concept in the mortgage process. The LTV ratio compares the amount of your loan to the value of the property. There are many different factors which impact your home affordability, such as your credit score, the property being used as collateral, your income and the ability to service the debt, the amount of capital you have in savings or investments, and the size of your down payment. The LTV ratio is critical because it helps lenders assess the risk of the loan. And just to give you an example what this means, if a home is worth $1 million and you have an $800,000 mortgage, this means it's an 80% loan to value ratio. And dependent on what this percentage is, it will determine whether or not you have a high ratio or insured mortgage or a conventional mortgage, which we'll get to in a minute. Conditions like the purpose of the loan also impact the loan to value ratio, making it a key determinant in your qualifying rate. Another crucial factor in determining your mortgage affordability is your capacity to service a mortgage payment. This means not only being able to make the mortgage payment itself, but also managing additional costs like taxes, monthly heating costs, and half of strata fees if applicable. Lenders will conduct a stress test at a higher interest rate to ensure that you can afford these payments even under tighter financial conditions. It's also important to consider your ability to manage these payments along with other debts you may have, such as car payments, credit card debts, or student loans. Your capacity to afford a mortgage is tested through two debt service ratios: the gross debt service or GDS ratio and the total debt service or TDS ratio. These ratios, also known as debt to income ratios, measure your household and total debt carrying capacities against your income. For joint applications, the qualifying ratios consider combined debt payments and incomes of all borrowers. Generally, for insured or insurable transactions, lenders allow up to 39% for GDS and 44% for TDS. However, these ratios may vary among lenders based on their risk appetite. Insured mortgages occur when you put down less than a 20% down payment. Uninsured mortgages, on the other hand, are when you put down 20% or more. Examples of when an uninsured mortgage, also known as a conventional mortgage, is required is when the purchase price of the property is at or above $1 million, as well as on all rental property purchases. With a conventional mortgage, the amortization period can exceed 25 years, generally with a limit of up to 30 years aside from certain lenders. Additionally, if the transaction is a refinance, lenders may apply elevated debt service ratios based on their risk assessment criteria. In such cases, a borrower's unique financial situation is taken into account, and lower debt service ratios may apply if the risk is deemed higher. To calculate your affordable mortgage payment, you can use your annual income and subtract any applicable debt payments. Using an example of a joint income of $100,000, we'll apply the widely accepted debt service ratios of 39% for GDS and 44% for TDS. For simplicity, we'll consider taxes at 1% of property value and a flat $100 a month for heating costs. Assuming no outside debts or condo fees, we can calculate the maximum monthly mortgage payment you can afford based on these ratios. The easiest way to understand how these items affect your purchasing power is to look at what fraction of your monthly mortgage payment they affect. As you only have 5% to work with on a difference between 39% on GDSR and 44% on TDSR, it is best to think of this as an annual amount. So in the case of a borrower earning $100,000, any outside debts cannot exceed an annual payment of $5,000 or a monthly payment of $416. We find that by doing the following. To find GDS, you will take your $100,000 income and multiply it by 0.39 and then divide that number by 12, giving us $3,250 monthly. You'll then do the same for TDS, but this time you'll multiply it by 0.44, which gives us $3,666 monthly. Then you take TDS and subtract the GDS, and that gives us $416 monthly. That means that a person or family earning a combined income of $100,000 will be able to service monthly mortgage payments, property taxes, and heating plus half of condo fees up to a maximum of $3,250. They can carry up to $416 monthly in outside debts such as car loans, student loans, or up to 3% of the balance of all revolving debts. This means up to a $13,867 balance on your credit card or lines of credit combined. And there you have it. It's just that easy. Just kidding. There's more. You'll also need to pass the mortgage stress test to qualify for the mortgage. This test requires proving that you can afford payments at qualifying interest rates higher than your actual rate in your mortgage contract. You'll need to pass a stress test to qualify for a mortgage regardless of whether you need mortgage default insurance. Federally regulated lenders must be able to show that you can service your loan at the higher of the contracted interest rate plus 2% or 5.25%. For example, if your mortgage broker is able to get you an interest rate of 4%, you would actually need to qualify for the loan as if it was 6%. However, if your actual mortgage rate was 1.5%, you need to qualify as if the mortgage was at 5.25%, as you always take the higher of the two. Moving on, let's talk about mortgage default insurance. Also referred to as an insured mortgage default insurance is required when your down payment is less than 20%. In these situations, you'll need to purchase default or high ratio insurance. So generally, this is only allowed to be done on purchases that are for your primary residence and are less than $1 million. The premium that you're charged on the mortgage insurance is then added to your total mortgage amount. In Canada, there are only 3 insurers, which are CMHC, or the Canada Mortgage and Housing Corporation, 𝐶𝐨, and Canada Guarantee, with CMHC being the largest and most commonly used out of the 3. However, you don't get a choice as to who it will be. Once the high ratio default insurance is purchased from one of the 3 default insurers, the risk to the lender is reduced as the default insurance will protect them in the case of default. A key fact that many people don't know is that the lowest interest rates are actually offered to those with default insurance. This all comes down to the fact that the bank isn't taking on as much risk, so that's why they have the ability to offer this. All things being equal, the lowest rates will always be offered on an insured purchase as mentioned, or a renewal. However, do keep in mind that with an insured mortgage, you will have to pay a premium of between 2.8 and 4% of the total mortgage amount, and of course, over the same period of time, this means you'll be paying more interest. And just for clarification, an insured renewal is one where the borrower purchased default insurance with the home. The second lowest rates apply to an insurable purchase where the borrower puts down 35% or more of the purchase price as a down payment. Similarly, this also applies to renewals where the property has 35% or more equity at the time the mortgage is renewed. This insured or insurable mortgage rate pricing only applies to mortgages where the property value is less than $1 million and the new mortgage will be amortized no more than 25 years. An insurable transaction means that the lender arranged insurance on the back end to protect themselves from the borrower defaulting. This automatically comes with better rates, even though the lender pays for the insurance premium, which is much lower. In conclusion, determining your mortgage affordability involves a thorough analysis of your financial situation, the value of the property, and the various ratios that lenders use to assess risk. By understanding these factors and how they interact, you can accurately calculate how much you can afford to borrow for your new home. This knowledge will help you navigate the home buying process with confidence, ensuring that your dream home is within your financial reach. However, prior to home shopping, you should still be going to a mortgage broker or bank. I highly suggest a mortgage broker to get an actual pre-approval prior to going home shopping. And there are multiple benefits to this, but the primary reasons being is that you'll get an actual clear picture from a professional of what you can afford. And number 2 is the fact that they will already have all your documents. So once you do have an accepted offer, they will be able to process and approve that mortgage quicker. And if you're in a competitive market like myself, this can provide you with a massive advantage. And that's about it for today. So if you did get any sort of value from this video, all I ask is that you hit the thumbs up button. And if you'd like to see more videos just like this one, I suggest you consider subscribing subscribing to my channel. If you do have any questions or comments, leave them down below and I'll be sure to get back to you whenever I get a chance. Lastly, if you are considering buying or selling in Surrey, Langley, or any of the surrounding cities for that matter, or you just want to talk about real estate, you can scroll down and click the first link in the description to book a call with me at a time that works best for you. Thanks so much for watching, and before you get out of here, make sure you check out the next video in our home buyer series or another video on our channel, and we'll see you in the next one.